Hello everyone, welcome to the analyst classroom. Today we're gonna learn about the cash flow statement. Cash flow statement is one of the most important statement in the financial report because it shows the actual cash from which function, how much cash is business is earning. So let's start with the method of the cash flow. So there are two types of the cash flow preparation: direct and indirect. Direct is simplified and more detailed, is preferred but rarely used by the industry, the companies. And the indirect is basically companies prepare cash flow statement from the net profit from the income statement. I will show you the in detail. So indirect cash flow statement is most commonly used in practice, and there are three component. There are three parts of the cash flow statement: CFO, cash flow from operations; CFI, cash flow from investing; and CFF, cash flow from financing. So cash flow from operation means cash from core business operations, uh, from where the company earns the cash, sales sales of the main goods or the purchase of raw material outflow. This is the core business activities. It should be good. You you under if cash flow from operations is positive, that means company is generating cash from its core business activities. If it's negative, then company is might be in the trouble. Then the second is the cash flow from investing. Means company is selling his asset or long-term assets and receiving the cash. That's why it's positive. But if it's negative, then it's okay. So it should be negative because it's investment. Comes to the cash flow from financing. Financing means funding sources, where from where the company gets its capital or the equity or debt. So cash from funding sources, equity and debt, goes to the cash flow financing. It should be positive. It means company is raising the debt, or it should be stable, not much positive or much negative. It should be stable in a ballpark area. So the next is CFO is negative while CFI and CFF is positive. Means cash flow from operation is negative. You should be looking segment wise, not the overall cash flow. If overall cash flow is positive, but when you go deeper, cash flow from operation is negative, and cash flow from investing and uh, financing is positive. Overall cash flow statement is positive, doesn't. So in this case, if cash flow from operation is negative, business is not making money but borrowing and selling the asset. Means company's core operations are in loss and company is getting cash from selling his assets and other funding the sources. So company might be in the serious trouble if you find this type of cash flow statement. So be cautious. Then we let's talk about the methods. Direct method of cash flow statement. So direct statement. Direct, it's a simple cash flow from operation. Cash receipt minus cash payment. What you what you have received during the year in terms of cash minus you cash payment to the anyone. For core operations or cash receipt minus cash payment. That's simplified. It's like a preparing a cash based profit and loss statement, but only recording only cash statements. But only recording cash statement. Okay. I have understood. I have explained the PNL how it's PNL in prepared in the earlier videos. It's just like that you are recording transaction wise in the daily direct method in the case statements. So and one another point is if company is if company reports the indirect method indirect method, they must also disclose the direct method in footnotes under the IFRS, not mandatory in the US GAAP. Means if you are using indirect method in your financial reporting under the IFRS rule, you should be disclosing the direct method also in the footnote of the financial reports. So the direct method is important. And one of the biggest investor of the world sees about the cash flow statement is the income statement is a fiction, but cash flow statement is a truth. You will understand why. Because cash flow statement shows the reality of the business. Income statement can be manipulated by showing unnecessary income to boost the sales. So, but cash flow statement will only account for the cash received or paid by the company. So it's very helpful. So here is the some of the transaction, and we are gonna prepare the income statement, balance sheet, and cash flow statement based on this transaction in the direct method. Company is how company will account for in these statements and how balance sheet is worked. Okay, so the first transaction is the cash cap. Suppose you are starting a company and to start a company you gonna invest, you gonna put the capital. So capital issued is 25 lakhs. So the capital will be shown in the balance sheet, equity and balance sheet side. So capital 25 lakhs. Okay. And if business is receiving the capital, he will get the cash. So cash it's the financing activity. So capital 25. Okay, it will be cumulative balance, okay, of the cash flow statement will be come to here in the last. So I will set blank here. If you want to show this case here also, you need to revise for cash for the every statement, every transaction. So what we're gonna do is we prepare the cash movement here and we will transfer to these assets. Okay. So the another next transaction is bank loan raise 15 lakhs. So 15 lakhs bank loan raise. So bank loan 15 lakhs. My bank loan 15 lakhs. The next is the land purchase 20 lakhs. Land purchase asset. Land purchase 20. Land purchase 20 lakhs. It's an investment. So land purchase 20 minus 20. It's outflow for the investment activity. Then the building purchase 15 lakhs. Building purchased 15 lakhs. So building minus 15 lakhs. Okay. The next is sales 80 lakh you 18 lakhs sales. So you sold the goods worth of 18 lakhs. Sales 18 lakhs. Okay. Credit sales. So credit sales means 15% you sold on the credit, means you sold the goods worth of 80 but you received only 50%. So sales will be sales will be 80, no 80 not 40, it's a 40, it's a 40, it's a 40%. Sale is the 40 because it's and because because we prepare the uh, prepare the financial reports on the accrual basis. We shows the 80 as the sales, 40 is the cash flow from the sale, and another 40 I sold as a credit. So my accounts receivable on the asset side will show as a 40. It's my asset. Then general expense 5 lakhs. General expense is a cash flow from person. Then total salary expense is 10 lakhs. My total salary expense is 10 lakhs. Outstanding salary is 20, means my only 20k. So my salary expense paid in cash is only 9.48. 9. So salary expense 9.8, and then my outstanding salary, it's a liability. So outstanding salary 0.20, 0.20. Okay, it's in the lakhs. So it to put in 0.20. And the depreciation of the fixed asset. So depreciation of the fixed asset will be, I need to put it down, or so depreciation should of 20%. So land can't be depreciated, buildings can be depreciated. So depreciation 15-20% of the 15, it's 3 lakhs. Oh, okay. So, and depreciation will reduce my value of the asset 12. So, and depreciation is not a cash transaction. So, this is the transaction. Now we're gonna close the books. So, what would be my profit? 80 minus 575, 65, and 362. Okay. So, 62 lakhs net profit will be 62 lakhs, and 62 lakhs will be transferred to here retained earning. So retained earning will be shown below the capital. Is my retained earning 62. So I calculated the cash, and to save the time I delete the balance sheet. 25 lakhs from point 2 from the cash from operation, investing minus 35, and financing activity 40 lakhs. Overall 30 lakhs of cash cash movement. 30 lakhs he received from the business. And in the cash flow statement, here's the one thing also, that this 30 lakhs is only the 1 year movement. If company has the beginning cash uh, in the start, then the beginning cash plus this, then the closing cash will be our all thing. For example, this, if company has the cash balance of 100 in the 2025 and 2026 has 150, then the cash flow statement is not for this 150 or this 100, it's the 50 of the difference between these two. It could be the from the operations, investing, and financing. This 50 is our cash flow statement. So it's just a moment, start from the beginning, moment, and closing. So this is the cash flow statement preparation simplified in direct methods. And let's talk about the indirect method of the cash flow statement. So the indirect method of the cash flow statement start with the net profit after tax. Net profit is this. So basically what the financial reporting guys do, they took the net profit from the income statement. Then what gonna do is he uh, mm, add the non-cash charges to this net profit. For example, depreciation or any another amortization or thing to get the real cash. So from in the net profit he adds the non cash transaction minus the non cash payment that should be not be deducted from the net profit to get the real cash balance of the business. So they subtract non cash payment, then then they add the charges to income statement, not of cash flow from operation. Means we are gonna compute computing first the operations cash flow. So which is not part of the cash flow from operation transaction, it added on and subtracted from this part and later added on the respective function. So charge to income statement not CFO is added and minus credit to income statement not of CFO is subtracted. So with this movement we're gonna um, get is the cash flow from operation before working capital changes. Working capital means movement of the current asset and current liability. Liability will be have a direct relation. If liability goes up, cash will be goes up. If current asset, if assets will be down, my cash cash will increase, and in the reverse portion also. So asset has the indirect relation. It also includes the deferred tax asset and liability because the tax liability deferred tax asset is explained as that the uh, a deferred tax as deferred tax liability occurs when a company pays less tax today but will pay more in the future due to difference between the accounting rules and tax laws. So impact on the cash flow statement: if deferred tax liability increase, you should be added. And in the reverse side also, if so, deferred tax asset means company pays more tax today but will pay less in the future. So this is the basic understanding the working capital, and this is the uh, current asset liabilities side, how will impact the balance sheet, and the will you will get the cash flow from operation from this movement. So the cash flow movement is between the last year cash and the current year cash plus change in cash. I will explain this. Make the another part to explain the some of the examples examples in relation to the exam, how CFA exams will ask the question related to this cash flow statement and how you will solve in a shortcut method. What is the difference between the gap and IFRS, and I need to cover the another topic called the free cash flow from for the equity and free cash flow for the firm. So I will make the another separate video on the part 2. So stay tuned and leave a comment below for any suggestion. Thank you for listening.